This chapter 2 focuses on inflation and its main drivers and indicators, including consumer price indices, producer price indices, labor cost and productivity, and money growth. A principal objective of central banks and policymakers is the control of inflation and the maintenance of price stability. Inflation affects the pricing of goods, services, and other assets, and its presence filters into wage levels, pensions, exchange rates, interest rates, and many other key economic variables. Agents seeking to protect the purchasing power of their assets and incomes often alter their investment and trading decisions based on current and expected inflation for the economy, with high inflation seen as damaging to growth in the long run. Consumer inflation is normally defined as the change in the Consumer Price Index, CPI, an index that tracks the average price level of a basket of goods and services the typical consumer is deemed to buy regularly. The basket varies significantly from one country to another, but prices are usually indexed to 100 for a given starting year. CPI is subject to seasonal effects and therefore requires the price series to be seasonally adjusted. Also, inflation for specific groups of goods and services, such as food and energy, evidences more volatility than for others. This pushes market professionals to focus on what is called core inflation, a term that excludes energy and unprocessed food prices. Market professionals pay particular attention to the monthly United States CPI report released by the Department of Labor, especially since the CPI is widely used as the basis for indexation under a variety of contracts. The CPI basket is updated every few years based on an annual survey of consumer expenditures to capture changes in tastes and in the items available for purchase. Most policymakers focus on the core CPI. Another U.S. report that receives significant attention from market professionals is the Monthly Personal Consumption Expenditures, PCE, set of price indices released by the Bureau of Economic Analysis, which focus on consumer price inflation as determined by the final consumption of goods and services purchased by individuals or non-profit institutions based on a basket broader than the CPIs. Fed officials, including Chairman Bernanke, have focused in recent times on the core component of the PCE price index as their preferred gauge of consumer inflation, identifying the 1% to 2% range as their comfort zone. The BEA also releases a quarterly report on GDP-based price indices, such as the Chain Weight Price Index for GDP, which covers all goods and services produced in the United States and not just items purchased by consumers, as with the previous two price indices. This index, for example, includes construction, business equipment, and government spending. In Europe, Eurostat releases the monthly EU Harmonized Index of Consumer Prices, HICP, based on information collected from national statistical agencies. Indices are weighted averages reflecting the relative size of each EU country's economy. The HICP is widely scrutinized since it serves as the reference inflation index for the European Central Bank. Inflation may also be measured at the producer level through the well-known Producer Price Index, or PPI, an index that tracks monthly changes in selling prices received by producers of a defined basket of goods and services. The main subcomponents of the PPI are consumer goods, capital goods, ex-energy intermediate goods, and energy. Consumer goods are broken down further into durables and non-durables. Due to energy price volatility, core PPI is preferred as an indicator of short-term expected inflation. PPI data in the United States is released by the Bureau of Labor Statistics on a monthly basis and in the form of 3 different indices: the closely watched PPI for finished goods, i.e. products ready to be shipped to wholesalers and retailers, the PPI for intermediate goods, supplies, and components, and the PPI for crude materials awaiting further processing. In addition to the general level of employment in the economy, market professionals focus closely on the evolution of labor costs and productivity, given their acknowledged impact on inflation, production costs, and GDP growth. Labor costs include mainly wages and social security contributions paid by employers, and represent the largest component of firms and public administration's cost base. An increase in labor costs eventually pressures output prices, creating inflation, unless productivity can be increased commensurately, or reducing profit margins for businesses in highly competitive sectors. Higher wages support consumer spending, a positive for growth, but unless they are accompanied by sufficient productivity growth, are likely to lead to renewed inflation. If they cannot be passed on to consumers, they often result in lower profitability and freezes on hiring and capital expenditure. The size of the labor force and its productivity are key determinants of potential output. In the United States, quarterly employment cost indices are released by the Department of Labor, measuring changes in hourly labor compensation for different sectors. Indices for productivity and unit labor costs are also tracked through a second quarterly report from the DOL. Productivity indices measure changes in output per hour of work. Compensation per hour divided by productivity leads to unit labor costs, which are of great interest to financial markets. Changes in unit labor costs indicate the degree to which firms are under pressure to increase prices in response to changes in their labor expenses. In Europe, frequent wage agreements are negotiated regarding wage increases and labor relations. Because of their importance in setting future labor costs, these wage rounds often have a significant impact on the financial markets. It is now generally accepted that inflation sometimes results from excessive monetary growth in the economy. According to so-called monetary theory, GDP growth is usually accompanied by growth in the means of payment, but an excess of money growth beyond the target nominal growth of GDP is likely to result in excess inflation. Under this theory, money should grow just enough over the medium term to facilitate payments for the increasing amounts of goods and services produced in the economy without excess growth that can cause price instability. Policymakers and market participants observe closely indicators relating to the economy's monetary aggregates, tracking in particular excessive monetary growth that could prompt inflation. Analysts, however, keep carefully in mind that deregulation of financial activity and increased globalization of business have caused a weakening of many traditional relationships between monetary aggregates and economic activity. The Federal Reserve in the United States tracks weekly changes in the different monetary aggregates, the well-known M1, M2, M3, and so on. The ECB does the same for the Eurozone, but on a monthly basis. Other important reports track the growth of credit extended to specified sectors in the economy and changes in loan conditions, such as the quarterly Senior Loan Officer Survey and the Flow of Funds Report released by the Fed, and the Consumer Credit Report, also released by the Fed, but on a monthly basis. These reports include significant detail about the characteristics of the loans extended. This brings us to the end of this chapter 2.